practice, from companies that we've seen, and we've done enough of these now, I'm pretty sure that we have a pretty good idea. I mean, just for perspective, we have 2 rounds that I think, well, should be closing by the end of September that are both African-based companies. One will be raising 60 to 70 million of equity, which is great, bigger than they first thought. And then the other is raising a 20 to 30, but in a two-part round, effectively. The next one will be 50 plus. So they will raise almost 100 million of fresh equity by the time it's all said and done. So, you know, and what we're seeing more and more is that companies at least are thinking about raising larger amounts of money, more than probably would have ever expected at this stage. So not everything is going up and to the right, but you know, the signs are more positive than I probably would have expected at this stage. So it makes these kinds of discussions most relevant. So my vantage point is that we typically work on later stage rounds than many of you are aiming for at the moment. Normally it's C and C+, and then also M&A. Now, the value that Eloho thought, and I thought would be relevant, is of course, it's very useful to look at what that looks like and then work backwards, because as you transition from A to B towards C, the worst thing for somebody like us advising on deals like this is that companies are less prepared than they should be. And ideally, they could have done certain things or instilled certain disciplines perhaps in the business other than just running the company and growing it that could make their journey to raising a larger amount of money more certain, more successful, and ultimately get scale faster. And so we thought it was useful to look at it from over there and then work backwards. Even if not everybody in this room is going to be raising $35 million next quarter. In fact, precisely because of it. So there's a little bit of homework. I think probably in the interest of time, maybe we won't do the longer piece, but there's 2 pages of, it's an article, nothing to do with me, but there were 2 articles. There's another one that's longer that I'm happy to send around afterwards. And it really was just to get everybody thinking about some of the issues and reading. There's so much literature out there, right? I will tell you that a lot of it is wrong. A lot of it is contradictory. And a lot of it is very high level. Like, oh, you should do this better. It doesn't really mean anything to anybody to do this better. I mean, you know, so what we're going to try and do is dig in maybe 1 or 2 layers further down, get very precise, and some of the slides, not necessarily that they're busy, but some of the slides have got fairly precise detail on calculating metrics and, you know, things to watch out for with investors and things like that, that, I mean, inevitably you're going to want to have a set of questions on. So the rules of engagement are that I'm happy to hear my own voice for the next 1.5 hours or whatever. You may not. So I would invite any of you to just jump in at any point in time. The benefit of this is that it's a workshop rather than a larger group. So just first of all, why am I up here? So I've personally worked on 120 plus deals across 25 plus years. So I think I'm a pretty good barometer for pretty much what can happen. So I've in my career, which is about 25 plus years, I've built 3 different M&A advisory businesses. And I'm not going to go through the bio in detail, but the first 2 are still around, so in different guises. So I just wanted to prove the second time that the first time wasn't luck. So if you do it 2 out of 2 times, then the first time probably wasn't luck, let's put it that way. And I'm on my 3rd and last. So, and then I taught at INSEAD, the business school, as probably many of you know, in their entrepreneurship department, I taught exit preparation for 6 years. So, and you know, the overlap with large round preparation is probably about 75%. So there's quite a lot of the discipline that I had built up over a number of years, and a sort of a framework for a playbook, I would say, that then of course we adapt in the practice that we do. So I think I can claim to have kind of written the book, even though I haven't actually done anything on it, on this, so hopefully that's particularly helpful. But the most important thing is that we're working in the market on these kinds of rounds right now. It's not just some kind of, you know, it should be like this. Yep. Now, let's get into it. So what are the key messages, right? So everybody knows almost every week there's a surprising amount of money being raised by a surprising company, it seems. And it's now become so normal that we're so used to it. But it is starting to drift to the African continent. And whereas companies perhaps in South Africa would have been raising money, but elsewhere was more difficult. You see it in Egypt now, where I was born. You see it here. You see it in East Africa. And you will see much more of it here and in East Africa over the next 12 or 18 months. Just from the pipeline we have, you will see much more of it than would have been visible over the last 12 or 18 months. So the market's in transition literally now. Second point, we are seeing some valuation headwinds. What is a headwind? A headwind means that it's choppier. It's not quite, everything's not always going up and to the right. And we'll talk about that in a little bit more. I'm not going to spend a lot of time on it because frankly, there's not a lot you can do about it other than think about timing from that point of view and maybe the amount of money you raise, but otherwise, it really is outside of our collective control. So it's an observation. The third is very important, which is the companies, you know, a lot of people will say, well, you need to really be very prepared to raise a larger amount of money. And the larger amount of money you need to raise, the more prepared you need to be. But companies are often unsure exactly how to prepare. Like, what exactly do you do? Do you hire a new accountant? Yeah, that's easy. I mean, we don't need to talk about that. And by the way, by the time you begin working with somebody like us, the ship's already sailed. You know, you should already have done this. It's actually why I'm here. We can't work with companies over years and years, so hopefully something like this is helpful at least to set the framework before I or we show up. And actually there's a playbook you can follow, more or less. We'll talk about the elements of that, and I said get very specific. So let's go, next slide is, what are we going to cover? The market quickly, basics, a playbook. Well, it actually works. That's the last slide. So I put it up here, meaning you can actually get a better result doing some of these things. Now, look, some of these are going to be more relevant for some of you than others, but we'll cover the whole gamut. It's useful to know. The more you know, the better armed you are. Context, very quickly. I hate slides about the market overall because sometimes, you know, oftentimes less relevant for you. So I extracted a very small number of slides that I thought would be directly relevant. So first thing actually has nothing to do with you in the room, but is very relevant. Yep. So which is European fundraisers and between 25 and 300 million, so mostly it's 25 to 100, and European exits in technology over the last few years. And you'll observe something very simple, which is this goes down or flatlines, and this goes up pretty dramatically. And I'm not going to read the words here, but what you'll see is the companies are opting to do larger rounds rather than selling early. Of course, everybody hears about Airbnb and Pinterest, et cetera, but the reality is it's drifting further and further down so that companies that have a market value or a valuation of, say, 100 million are opting to do the same thing, albeit with smaller amounts. But the idea of being able to raise money and extending your runway over many more years is just becoming well established much further down the chain. Now, I'll be the first to say, because they can do this rather than they should do it. I showed this slide in a very different presentation when, I knew it was going to happen like this, but yeah, that's fine. So we'll pause. No, that's all right. It's not your fault. Listen, I was in traffic this morning too, so let's. I think you have to go find the empty seat. I don't think it's fair to ask everybody to move, but you know, it's fine. And you'll now probably ask all the questions. Yeah. So, so the point in that context actually was, and this is also useful for everybody here to just be alive to. In the other presentation that I gave, it was really related to exits, and the point was that, you know, because people can access more money, they're doing it rather than stepping back and thinking at some point, is an exit a better idea? Because this market has been going up for a very long time, and at some point or other, companies keep raising at higher and higher valuations. And as you know, if you raise money at a $100 million valuation, you're aiming for a $300 or $400 million exit, and there are not that many of them in Europe, let alone here. So at some point, you get onto a treadmill where your valuation forces you into a certain way of proceeding and potentially executing. And it becomes very difficult. I'll be the first to say that somebody putting a $30 million check into a company at a theoretical valuation that's a price per share is totally different than a strategic writing a check. And what we're also finding, by the way, is that earlier stage investors have a real problem with this. They signed up for a 5 or 6 year journey with a certain amount of capital. All of a sudden, the company's raising 3 times the capital, and the runway's 12 years. So now we're having to unlock them in secondaries. So it's useful as you ramp up towards a B plus, C, C plus stage to just step back, and at some point or other, you have to get off the treadmill. And before you raise the next round, just think about what does that timing look like? Because, by the way, all of you in this room are not, well, you may be playing to raise larger and larger rounds forever, but probably not. And, I think, and so if that's the case, you may price yourself out of the M&A market if you're not careful.
I just have a quick question. Could this graph also mean that European startups weren't actually raising enough in the beginning, and now they're starting to drop off?
To some extent, I have the data on that, which, to some extent, but it's surprisingly close. They're actually closer than I thought it was, even looking backwards. Yeah. So that's less of an issue than I would have thought, and you would have thought. Yeah, I know. Conventional wisdom is, you got to kind of look at it a little bit, but because there's a lot of stuff that people post on Medium that, is just really unhelpful.
So you mentioned that there's a difference between strategic writing a check and the VC. Can you speak more about that?
Okay. How much time do we? I knew we should. I'm glad we allocated a little more time. Okay. Yes, and I'm not sure there's a later place to talk about it, so might as well just talk about it now. The mentality of strategics. So I'm talking about VCs, but VCs covers people also who write $50 million checks. So just people who do minority deals. They are betting on the extrapolation of history, effectively. And very often they get the extrapolation of history wrong. So the mindset of a strategic is really nothing to do with that, right? Most strategics, their interest is a very different, which is you may be a $40 million revenue company, but actually that doesn't make any difference to me as a strategic. I want to have a $500 million business unit. Yeah, I'm going to put more resources, et cetera. In order to get that $500 million business unit, I'm going to put in X over a Y time frame. Yep. My own valuation as a company is this. My own multiples are this. If I have a $500 million business unit, it's going to be worth that. Therefore, in order to buy the foundation for that, this is what I can afford. Now, I might be able to do discounted cash flow over a year, and we can talk about all the detail how they do it, but ultimately, which is why they can't write a $1 billion check for a $65 million company, even if they raise money at 600 pre. Because once it gets to be 500 million, I'm never going to get that value out of it. It's just impossible. And therefore, you find it, for example, in Europe, a good example is digital banking. A lot of the traditional banks would love to have a digital banking brand, but most of these banks have raised money at such high prices relative to their customer bases, it's actually impossible for a larger bank to buy them. They have no M&A exit. They've completely priced themselves out of it. That may be fine because they have such high valuations, and raised enough money that they have an opportunity to win. But there are only 3 slots on every podium. Podiums don't have 15 slots or spaces. So everybody's playing for the podium finish. It's a very different game. So the point is really to look at it in terms of building a larger business unit normally within a strategic. I'm talking about when they buy a foundational asset rather than a product line. I'm talking about really paying up for a strategic. There's a limit to what they can do. So now what that inevitably means is that strategics have lower multiples in mind than any investor at these stages, guaranteed. So the risk, if you think about it from that point of view, is you raise money at, I'm picking numbers, 8 times revenue from investors, and then 7 times revenue from investors. When you look to sell the company, strategic, the best ones will pay 3, because that's all they can really pay. And then what you find is that actually between the last round and ultimately selling, you need to grow up in revenue to a significant size in order to get the price to make it worthwhile. And then the clock has been ticking for far longer for these investors than they first expected. So it's a very generic explanation in terms of the mindset, but it's a completely different mindset. That, by the way, is an entire workshop in its own. So now you'll see this going up. Well, it's in tandem with the following. If you go to the next slide, which is there's an enormous amount of capital that's been raised. So this is the amount of money raised by not private equity firms, right? This is growth and venture. Funds above 50 million in size, so not micro fund. Oh, well, depends on which geography you look at, but not smaller funds, let's put it that way. Yep. And of course, this is SoftBank. But I put it in here because SoftBank's part of the ecosystem. When we are, the work we're doing in Africa, they've looked at a couple of deals. They're not completely off the radar screen. They will do deals, albeit they won't do $30 million checks, of course. But the interesting thing, actually, even if you take out SoftBank, is the number's grown, is increased, and it's increased consistently every year. The other interesting thing to observe is actually the median size of funds, when you look at it, has not gone up that much. There are just many more of them. So many more. And actually what we find now is this is just a dizzying array of funds, most of them irrelevant for African investment because they're raising money elsewhere, investing though, of course, right? But in a very buoyant market, what we find is every time we're running a project, there's a surprise. Somebody we didn't expect who is segment focused, whatever, actually is willing to take a look and another look and another look. And the reason is because they have a $200 million pre-money valuation, nearby, but actually they just can't make any money out of it. They're sort of forced to go further afield. Again, it's case by case, and most funds won't, but we're also finding the capital flowing to Africa is not always from exactly the same people all the time. And certainly the work we're doing right now, the interest that what you will see is of those two rounds, one will be done by somebody who's never done anything in Africa before he is writing a $40 million equity check, and then one is being done by somebody who has done before. So it's in that transition stage. To answer your question, by the way, I haven't preempted everybody's question. It just happens to be a lucky day for me. So the median B round in the US and Europe, you'll see here, was actually not that different. I would have expected it to be more different. Like, this is median. People are focused, of course, on absolute amount, and you average it and you get a very big number because some people raise ridiculously large rounds. But median is a much better, as you know, measure of just what's happening overall. So median is not that much, and it's actually the same now. On C rounds, it was the same before, and it's almost the same now. It's actually very surprising when we did the statistics. We would not have guessed that. So the point being is the world is flatter now and more connected now probably than even we expected, which actually augurs reasonably well for companies here, because it used to be that Europe had discounts and whatever. Of course, now it's much less, but still, there are plenty of funds who just won't invest outside the United States if they raise money in America, and yet what we're seeing is a closing of the gap, which also means that European companies have no excuse anymore. But that's a different point. So the amount of money available has just gone through the roof. And you'll see it, I mean, Rise is raising a much larger fund. Other people are raising much larger amounts of money that are also directly relevant for here. So now the next slide is very quick, and I'm sure all of you follow all the stats. So the point is, the market it is drifting towards the continent, and the numbers are still tiny. But again, my point to a few people over the last few months is you kind of need conceptually to multiply that by 8 or 10 because of the GDP, per capita ratios. So because that money is being raised to invest in the continent, and so conceptually you kind of need to multiply it in terms of its, I hate the word impact, but effect. Let's say, if you do that and you get 7 billion, by the way, that's European VC 5 years ago when you adjust it. So actually, there's a reasonable amount of money coming in, albeit small numbers. And then, of course, what you're seeing is an increase in larger rounds. You saw the Tala round and Branch before. I put Jumia in because their IPO was really a fundraising. In hindsight, anyway, but it's a fundraising. Let's put it that way. And then, Andela was kind of a round that should have been done later that ended up being done earlier, but look, they got the money. So we worked on Cellulant, and so hopefully we'll be able to populate some of this chart in the next few months. But it's early positive signs, let's put it that way. By the way, I will make a comment that I think it's probably more dependent on the market cycle than people might realize. It's just a personal opinion, which is that when the market is this strong overall, it does drift towards the next and the next geography. So, I mean, I was on a call with a company in Nepal, of all places, which has then got 2 term sheets. So, that kind of thing begins to happen. Now, I will say, for everybody here, when the market dips, that stuff starts to go away. And just like European software companies quoted on NASDAQ that nobody trades, it's the marginal incremental opportunities that people pull back from first. So let's not get ahead of ourselves and think this is just going to continue going up and to the right. Great if it's anchored by Africa-focused funds, but the reality is that of the people who could choose whether or not to look at deals on the continent, all of them will stop if the market turns down. So there's a time frame associated with it. Yeah.
You said earlier that because of Africa, we have to multiply the funds by 8x because of impact.
No, sorry, just GDP per capita. Just GDP per capita adjustment because, if you're going to raise 700 million in order to hire X number of people on the continent, obviously you can hire, yeah, exactly, yeah. So if you raise 700 million in Europe, so you just do the ratio. And so just in terms of the scalability that it could give these guys, that's my point. And my point is more that when you multiply it up, you get to a number which is Europe VC 2013. So we're not that far away. And also the positive sign, assuming the market continues, is that it only took Europe 5 years to accelerate into a much different total size bracket. It's like 2 or 3 times that now. I'm not suggesting it'll happen anywhere, but that's what a positive market can do. So.
And just to be a little bit, just to help with a bit of clarity around that, we're effectively saying a rule of thumb, 8x.
Or 10x.
Or 10x.
Yeah, so 700 turns into 7 billion.
700 looks more in terms of an impact perspective, like 7 billion of capital raising.
You can use the 700 million to buy 7 billion's worth of resources looked at from a European context. Exactly, and then when you say I can buy 7 billion of resources, that is equal to funding European companies to the tune of 7 billion, which is the European VC industry in 2013.
Right, so we haven't adjusted the Europe number, that's the
No,
actual
yeah.
Europe number.
Correct. Sorry, I was fair enough. That's just to walk through the math. There's a couple of very complicated equations. This is the most complicated. So there's one very complicated one later, which I'm sure you'll enjoy. It's this plus this. So it's also necessary here. If you go to the next slide, yeah. So I mean, capital is a strategic asset very often everywhere, but probably even more so in Africa. And the thing that we've observed is because there's a squeeze on the availability of senior talent, and some of you are probably enjoying that, and some of you are suffering from that. But what we find, for example, is the price you have to pay for a seasoned senior executive in Nairobi is just off the charts because there's so few of them. So that's an investment which, when I just did the math, 700 million to 7 billion, it doesn't work if you have to pay $120,000 a year to somebody in Nairobi because there's only 5 of them available. Of course. So there's an additional requirement, and then when you're doing cost down engineering for products, and then you have to build also direct sales because logistics is broken, distribution is broken, etc. And also a lot of times you have to basically build, not rent. A good example, I'm probably some of you in the room, you know, you have to build agent networks. And if you're doing work in the financial system in Nigeria, I mean, you know, otherwise in another market, you wouldn't have to ever bother about that. The infrastructure would be there, and you simply just rent it for a small fee. So, and otherwise, you know, having to build out an agent network or do distribution and logistics in Nairobi, which is a painful thing to do anywhere in Africa, is just very expensive. And so what we observe over and over again is much more often than we first expected when we started doing work in Africa a couple of years ago, is that the first 5 or 10 million oftentimes has to be, quote, wasted on replicating things that otherwise you could just rent. And so actually, when we say the capital is a strategic asset, well, it's even more relevant, although on the one hand, yeah, you can raise 30 million and it goes the distance of 300. In another way, actually, the first 5 or 10 has to just get kind of flushed down the toilet almost. And so it becomes even more important, I think, for companies on the continent to be able to raise a certain minimum amount of money just to get the incremental amount to be able to scale after the first is gone, which creates more expensive term sheets and more expensive cap tables. And then when we do Series C rounds, it all comes home to roost. So all of this is fine. Just a word on the headwinds I talked about before. If we go to the next slide, I'm not going to spend very little time. There's a little bit of, you know, investors urged startups to hoard cash. You probably saw this in the FT. The outlook is changing for 2019. Look, this is a very cheap thing to say. You know, yes, it's doom and gloom. But I'll tell you what we're finding is that there's more pricing discipline at Series C now than a year ago. Investors are pushing back. They're willing to do deals, willing to move fairly quickly, but there's a certain maximum that they will do, and that is becoming harder and harder. And that's just a fact of the market. By the way, from my point of view, again, trying to be neutral here, because of course we're advocates, is probably not a bad thing. It means that the market strength will continue for longer, because the worst thing is, you know, there's pricing indiscipline. A few companies, and maybe some of you, benefit from it, and the rest don't.
And
So,
conversely, better pricing discipline at Series C, what is potentially the takeaway for someone who's in this room at Series A or B in terms of how they think about, to what extent has that started to slow down to some of the
no, it's hard for me to say. We don't really work at that earlier stage. So I'm certainly seeing A and B rounds that still surprise me, but that's anecdotal, and I don't want to give you an anecdotal answer and pretend that it's more than that. So being blunt, you may still be able to get away with it at A and B, but you can't get away with it at C. Okay. There's some basics. So there's a very complicated equation that has to do with fundraising, if you go back, which is, yeah, this, I'm sure take you a few minutes to get this here. So perception and plus reality equals value. And the point here is that, I'm going to make a couple of points. One is, perception is not spin, if you know what I mean by spin, which is just, you know, we send out a lot of press releases. I mean, perception is a series of corporate marketing efforts that you do that's well thought through, that project a bigger image of the company than it is. And I will tell you that when I first moved to Europe and was working with European technology companies, the number one consistent problem is they just didn't project themselves. And for many years, they've gotten much better, but still, there's still a discrepancy between the kind of instincts, I would say, of a lot of people in the Valley and people even in Berlin, which is as much close to a valley as you probably can get. But it is a discipline around perception. It's not hype. Yep. And then reality. Okay, so we all know, what's the thing about facts? When, you know, the Trump thing about facts is like they're, I can't remember the alternative facts. Sorry. Yes. Thank you. Yes. So, how do I say? There's a gamut of reality. Okay. You can take the same. This is what we can spend some time on. You can take the same data, and you can do this with it. Yeah. And you can tune. I would say tune reality so that it amplifies the perception. So whereas actually perception, you need to put rigor in it and reality in it in order to execute. It's kind of like if you if you do any writing, creative writing or business writing, revision is really what makes the art. And very few companies really are tuned even how to think about doing that in a way that is ultra credible. You're going to deal with people who are sitting on billion-dollar funds. They are not going to be interested in, you know, smoke and mirrors. We're way beyond that stage. So we'll talk a little bit about the alchemy, but the combination of the two. So I would say that occasionally we come across a company that has really thought through how to tune reality. Occasionally we come across a company that has got the discipline under perception. Very rarely, and I'm struggling to think of one, has combined the two in parallel well before raising a round. I can't think of one.
Could you give examples of, from your past experience, of how X company has tuned reality?
Yeah, I'll go through elements of that. I'll certainly focus on the reality piece. The perception piece we can talk about. It's just otherwise we'd be here literally all day. I've done these workshops all day, right? Because, and I can't cover everything. But yes, we'll do, yeah, exactly. Otherwise, it's not really valuable. So, yeah, you need to become an artist, actually, and a storyteller. Now, everybody says, let's go back a little bit. The 50,000-foot thing is, oh, you need to tell a good story. That's part of the equity story. You need to write a deck that tells a good story. Great. We don't need to spend 2 seconds on that. The point is, what I talked about, the perception and reality, is the tuning. It's the 10,000-foot level that becomes extremely important because, frankly, everybody ignores the 50,000-foot thing. If there's one thing I would say about it is, can I use a word of profanity? Yes. Okay. 95% of the stuff about telling stories is bullshit. Just complete. I mean, you know, it's not even worth the paper it's printed on, because the assumption is somehow you're going to dazzle people who are smarter than you, who have more experience than you, who have 4,000 people before you have tried dazzling, right? And who are trained not to be dazzled, okay? And you are going to, it's like somebody who is a guaranteed atheist taking them to church, sitting them in the front pew, and then just getting up and giving a sermon, and boom, all the lights come on, and you know they drop to their knees. It's not going to happen. It's like never going to happen. Companies spend so much time dazzling their story, and nobody cares. No, sorry. If you're doing a seed round, you don't have a choice. That's what you have to sell. If you're doing an A round, you can still get away with it. B round, it starts to shift depending on which kind of investors you have. Still can feature. By the time you get to C, you know, it's an easy thing to do. And also, like I said, you read most of the material and that's what people tell you to do. It's bullshit. It doesn't mean don't focus on crafting a deck. It doesn't mean don't think through the equity story. And I'm going to talk in a second about what thinking through an equity story can look like in practice, just a very high-level example. But that's the kind of thing you need to do. You need to do a lot more work. Now, there's a payoff for it. You get more money at a higher price with more certainty. And since capital is a strategic asset, it's probably one of the highest uses of your time. As I said, for most CEOs, though, they just don't know what to do. Like I get up in the morning, I'm ready, Victor, I'm ready, we're ready to do this. But what do you do at 9 o'clock? So, okay, we'll talk about that. But I just want to, the health warning.
Because that advice or that perspective, you would say applies across the board. Earlier in the discussion you mentioned potential that there was a European discount. I mean, there's a general feeling that there's typically an African discount as well.
Yeah.
And I wonder if storytelling helps to, mitigate that in some way.
Well, okay. The answer is undoubtedly yes, but let me give you a devil's advocate point, which is that the one thing I have heard much more often is that African companies are not as focused on unit economics, the same do you, are not as focused on execution build out of very specific things, underestimate the cost of internationalization and the execution of internationalization, just put, dots on the map. Yes, we're going. By the way, it also applies if you're in Nairobi and say, oh, we're going to Uganda. Well, Uganda actually is a different country. Like, I know it's almost, right? Or we're going, one of my favorites is we're going to Ethiopia. Great. I mean, all of you know, it ain't that simple, but it's sort of like, well, it's a country of, hundreds of millions of people. And so the sort of the much more important set of issues are around rigor of analytics in the business. What is it that you're measuring, being able to present those, and therefore being able to present a credible execution roadmap. By the way, which undoubtedly, even at Series C, you only know part of. I mean, nobody has figured it all out at Series C. You just need to sound like you figured it all out. So my point is, you're right, but the biggest complaint we hear is around different things. And by the way, everybody, when you get to around Series C, calculates unit economics. Everybody calculates churn and all that stuff and presents it. I mean, I won't name names, but there are companies that are doing 100 million of revenue that have calculated churn in a way that is wrong. I mean, it's wrong in the sense that it doesn't fully comprehend all of the elements of churn. That's not because they're not smart people. They're much smarter people than any of us. It's just they have never been pushed to do it. And they have a mix of impact investors and earlier stage investors who, frankly, it looks like we're doing okay and we don't really need to worry about execution and getting to profitability. I think one of the changes also is that when you're getting Series C, people are looking forward to an exit. They're not looking back at how you started the business. Series B, you still get away with the kind of looking back to, we started it this way, look what we've done. Right? But Series C, it's always looking back from an exit. And so therefore, it becomes more and more important, exactly how unit economics are calculated and exactly how churn is calculated. This is where I'm getting to when we're talking about flexing reality. Now look, the numbers are the numbers. So you get certain customers, they burn off, that is it. But I'll show you a couple of things to think about in terms of how to think about how things should be calculated, that, by the way, show dramatic differences. So I give you an anonymous example of a problem we ran into earlier this year on a £60 million fundraise, which was a serious problem, and it was really, how do you calculate this? And we had a fundamental difference of view between the ultimate investor and the company, and a fundamental difference of view between the investors who are interested in the company. So this is not something that is somehow solved, and all you need to do is get to an answer. No matter what investors tell you. Are there any investors in the room? Okay, this is not for them. We don't, I should just say, we only work for companies, we never work for investors, so it makes it very simple. All right, the next thing, so we talked about structure preparation and that having an outside-in perspective, which we're already talking about, which is looking at it from the investor's point of view, and also, as we talked about earlier, looking at it from an exit point of view, people will buy and why it is that they would buy, but it's hard to do when you're doing 100 miles an hour building a company. Easy for me to talk about, but that's my job. Okay, if we go, next slide, so it starts with time. I mean, all of this costs time. So the rule of thumb is CEO should spend 10 to 15% of his or her time, probably in the year before a round, investing in preparation for a round. No one does it. I mean, maybe one out of 100. No one. And they never do more. So you can read these. Growth drivers, we'll talk a little bit about that. Defining, articulating what you do that's really hard. This is a big one. Because companies take for granted stuff they've done that's hard without quite appreciating just how hard it is, and then that becomes an important part of the equity story. And at the end of the day, investors put money behind companies that have solved hard problems, done things that are hard to do, and have come out the other side. Now, clearly, you have to tune the story if it's Series B or C. If it's Series B, you're still in the problem and solving it. So, you can't really claim victory yet. So I'm, again, please bear in mind, I'm looking at it from Series C and D and onwards, you've solved more or less the problem. So you should get full credit for having done something that's hard. Whether it's building out a network, whether it's actually internationalizing in certain markets, whether it's have done multi-product lines as opposed to a single product with derivatives, having complex sales channels, multiple different channels, building partnerships, whatever it is. The biggest challenge actually starts with CEOs sometimes being able to identify what it is they've done that's hard, because they have a pretty good idea, oh, I've done that's hard. But actually, when you look at the list of things and start to look at them in detail, you find there's quite a number of things. You need to be careful, by the way, not to put a laundry list in front of investors, or else you'll get them the other way, which is, my God, I didn't realize it was that hard to do. So, and so you end up, there's a judgment call here, but you get my point. At least get full credit. The reason being that plenty of other people who might consider raising probably may not have done, hopefully will not have done the same quality work and not necessarily come out the other side. And remember, it's always a competition. You're competing for money. Somebody will always look at putting some money into something else. So that's a very big one. Corporate marketing and news flow was what I talked about earlier in terms of perception. This is not hire an agency and put out releases, although that can be helpful. And there's a whole playbook around this, which I am very happy to go through with people. All of it costs time. So what we do is normally we will sit down with a company, go through all the things that make sense to do. I used to write for a newspaper, so I kind of have some idea of how some of this stuff works. And I understand what, and I do a bunch of conferences, so I guess, sort of affinity with it, but I know how much time it takes and how much distraction it is when you have to show up at a conference as opposed to meeting customers. So you need to be able to fit that within the 10 to 15%, but most important thing is having structure and rigor. So somebody responsible at the company, not a PR agency, for that, whose job it is to make sure that certain things get out the door. I was, for example, surprised Kobo got so much credit, partly because it was August, but every other day I'm reading an article about Kobo having raised a round. I mean, it's not the biggest round of the world, It didn't, when Andela raised their round, it certainly didn't get that much press, and Andela probably deserved 5 times, 10 times the press, and somehow it just, all of a sudden Kobo's a winner in the market now. They may not be, I don't know, but. So that's an example of how you can create differential perception. Somebody who's interested, myself, but not directly involved. So, and the value of that, of course, next time around, they're like, oh, I've heard of that company. And you shouldn't underestimate the fact that, the audience you're really playing for is not a local investment audience, right? The audience you're playing for are people you've never heard of. And what they want to be able to do is oh, I've heard of them. That's all you want. All you're playing for. Reduces the Africa discount. Right away. Sorry, let's go back. I'm sorry, I spent a little bit of time. Yeah, dating large investors. Everybody says go meet investors. Yeah, fine. How? Right? What do you tell them when you're there? Do you take a deck? Do you take a short form deck? Do you do a briefing? So we're we're getting more and more positive about doing what we call long form notes. We've done this for the last couple of projects, proved very useful, like 4, 5, 6 written pages, not necessarily to send to everybody, but that distill everything, particularly with more complicated equity stories, writing a narrative down. It's a version of what Jeff Bezos does at Amazon. Probably some of you know that every meeting starts with a several page memo. Everybody has to read it, absorb it, because it forces everybody to do thinking. It's actually very useful. And what we found is for investors who were further afield, right, who didn't really know, actually that was a very helpful aid. Because then they could read about, oh, okay, this is the trend, this is what's happening, and these are the things that are happening in the business in some detail, not an investment memorandum of 200 pages that nobody will read, and not a deck that's beautiful, but something that's a bit in between. So also think about how you package it. Maybe you would do a 2 or 3 page document that's sort of an intro document. Granted, they will not have looked at it before the meeting. The average time looking at a deck is 3 minutes and 10 seconds, apparently, yeah. So, but you could also start a meeting, the variation is you start a meeting and say, here, like I did with you, right? Have a flick through this. They read, oh, okay, now I get it. Now, of course, it's Depends on how well written the document is, but that's just one example. Not necessarily that's the right way to do it in all cases, but there are different ways of doing it in terms of engaging with investors so that you can educate as well as impress. And when inevitably somebody is a little further afield from the continent, they need some education, whether they say it or not. It's how you package it. So yeah, so dating large investors means coming prepared. And then GitHub makes a difference early. You know, it's yeah, changing. I mean, we've had a situation on a large round. Somebody changed accountants literally a month before we started talking to investors, that kind of thing. If it's uncomfortably early, that's probably about right. So just be aware of your discomfort. We talked about this, and we talked about this, which, by the way, for some of you means the moment you stop fundraising, you start the next one. I know. I don't make the rules. We just enforce them. Yeah, sure.
Regarding the there's no ideal structure for it. It depends on the one that the CEO gets. Depends on the investor, like getting the large investor. There's not an ideal situation or an ideal formal process that you need to pass through.
Yeah.
So it depends on the large investor.
That's a very good question. So there's a formula. You know, look at Peter Thiel's thing, or the Sequoia. Do a deck that's, you know, more or less what they say. Do that deck that's X number of slides, and then have it available. That's a standard form. The point. So, not for everybody. This is a hard question to answer in general terms. Sorry, my mind is going to specific investors, right? And you know, they wanted or would prefer it this way or that way. What I would probably do, if I was going to generalize, is I would probably oversee, or I'd probably do a 4 or 5 page written document, okay, with external input, not just yourself. Otherwise, you're going to write how great you are. That's not very useful, okay? And that will force you guys as a team to kind of condense the thinking into what's really important and have meat on the bone, you know, data, insights, things that are useful to educate investors, rather than we're great, we're great. That probably is a very useful document, even if you don't need it. Yeah, and then the deck, which is 10 or 15 slides, right? And then an outreach program. And the outreach program, of course, you're going to strangers, you're going to friends of friends through an investor network, and you're going to people who might have approached you. More and more, by the way, we're finding analysts at investment funds all over the US reaching out to African companies. Those outreaches are completely meaningless, by the way. But that means they're reaching out to you. So that may be also an opportunity to be able to have an engagement with somebody. I don't think for a lot of US investors, you don't really need a meeting. I'm happy to do a video call. European investors a bit more tend towards meeting at the moment. Of course, there's getting access to more of them, yeah, and having an introduction to them, which is always a challenge. So we do this for a living, so it's easy for us. I understand that not everybody doing it on their own, but sometimes some investors in your board can be much more effective than others. So I'm giving you a generic answer, but I would do more than the playbooks, than the whatever I said earlier. You know, write a Peter Thiel type deck, mail it out to people. There's more to be done. By the way, what we also have done as a variation of that is we've worked with companies on writing press releases that are much more detailed, not longer necessarily, much more detailed. So as a company we worked with that we wrote their end of the year results release, their private company. So, and put it on the company and then sent it out to everybody. It had in it pretty much all of the reasons to invest in the company. Yeah. Plus, by the way, they grew X% and did Y and whatever, all the themes, all whatever, and then there was an education piece to it, the context of the market. And we did it deliberately because we figured, well, you know what, that's a good way for it to get out in the marketplace generally, and a document which somebody can download from the site and read themselves. So you can take that 4-page document, cut it down to 2, turn it into a press release, put your results on it, boom. That's a version of it. And I'm sorry that I'm giving you 42 options rather than answer. The answer is that it is different for different types of investors. Yeah, but there's a lot of tools. My point is, there's a lot of different tools to communicate with the market rather than do a 12-page deck, follow the formula, hope it works. Part of it's guerrilla marketing, but you know what? You're in the marketing business. You're marketing your equity versus 42 other people. So if you're a good company, you're good at marketing. So just run it as a marketing project.
So I have an interesting question. Speaking about
The others have been interesting too, but Aloha will give you a, yeah, it's like the Olympic diving thing. She's going to give you a score of 1 to 10 based on the interest.
like it's working.
It's
So speaking about starting comfortably early, right?
yeah.
How do you, so typically when you're raising a round, you're asking for introductions because, you want to say boom, boom, boom about the company, and the introduction happens because they expect that you're raising a round.
Yeah.
When you're starting comfortably early, you're not exactly raising a round, you're more trying to date and trying to meet people.
Yeah.
What is that ask?
It's a very good question, because if I ask you for a meeting and I know it's going to be wasting my time, why should I do a meeting? Yeah, exactly. So what we would suggest is, it's a very fair question. What we would suggest is that if you're doing that, you tell people, we are going to raise a round over the course of the next few months, probably be a little bit vague. We are making sure to reach out to investors who don't know us, who we think are relevant, and here's the reasons why. You don't know us as well as you should, but we should absolutely be on your radar screen, and I can get you on get us on your radar screen within a very short period of time. I can do it in a half an hour, and then maybe follow up with a little bit longer meeting if it's interesting, but we are going to raise a round. And by the way, you investors, since you don't know us, are going to take a little longer to ramp up, so it's in your interest as well. So,
This
but
is after you've just raised the round.
no, well, okay, you can't do it like 2 minutes after you've raised, but let's say you're a few months before you raise a round, telling people you're going to raise in a few months' time, and particularly if they haven't done 42 investments in Africa before, they kind of recognize that, oh, okay, well, it might be interesting, it might fit the thesis, I probably do need to know more about it, and frankly, I need to get more comfortable with it. And I need to decide, if I'm the investor, whether I waste any time on it or not. So it's mutual, but it might be interesting. And when the market is very strong, like right now, they're more amenable to that, generally speaking. Like I said, if the market turns down, I think just before you came in, we were talking about that, all that will stop. They just will say, Africa, no. I'm solving, by the way, in most cases here when I'm talking to you about the investor who has looked at a few African companies and hasn't done one. So I'm going to the extreme case deliberately. Not that that's the only thing you should focus on, but just because if you can point towards that, chances are you will have oversteered positively to access those people who are just more engaged with deals on the continent. But yeah, I would, and you're always telling people that there's a reason why they should do the phone call. And the reason is in 4 months or whatever it is, you're going to look to raise money. So no, that you don't necessarily do 12 months before, certainly after your last round. So there's a measure of reality. But generally speaking, people don't do very much of that. And generally speaking, they start right before the round. I mean, I can't tell you how many companies have said, well, we want to do pre-marketing. So let's do that in September. Well, it would have been good even at a minimum. And not everybody has to do that from March to September. That also can take an enormous amount of time and waste it. But it would be good to have a little longer time frame. Or stage it. Some of you may not need it, because some of you are on the radar screens of enough investors. They know enough of, and so it's less necessary. Some of you may need more of it. It's a judgment call. So you need to decide from that point of view. There's always the risk of being general. I'm going to spend some time, by the way, after this. I'll just be available to talk one-on-one with anybody, because, again, we have to talk about specifics of situations. Of course you can. Of course. Right, so we are mercifully a chunk of the way through, so that's good. Now, there's, I'm not going to cover all the preparation issues, but this next bit, we now go into more detail on some of these things, okay? And these are 8 different areas, no surprises here from just the framework that we use. It's actually the framework that we built up at INSEAD, and then now I use it. there's a lot behind it. We're just going to only have time to touch on 3, and not really in as much detail as I would like, but just to maybe cover a few things that I know will be relevant to you. So the first one is on positioning. This is, again, a full day.